Hi, this is Rick Leibowitz from the Columbia Gorge Small Business Development Center, and I'm here with my friend Noah Brockman from the Capital Access team. And we're here to talk to you today about getting a business loan. Things we'll cover today is why get a business loan. We'll go over the debt funding process. We'll talk about finding the right lender, what they're looking for, and how to make a good first impression with them. The first thing to talk about is what are loans for? Loans or debt financing, those terms can be used interchangeably, should be used for very specific purposes. The most common categories are leveraging capital to pay for fixed assets over time. So for example, if you were to purchase a car for $30,000, that car would last for 5 years at least. You don't want to put that $30,000 of capital out in the first year that could be used for running your business. So you want to spread that payment out over 5 years. Other purpose for loans would be operating capital. This is to cover initial inventory purchases or inventory expansions, and accounts receivable, which is money that your customers owe you but might not be able to pay right away. And then finally, loans could be used for working capital, and this is to temporarily cover expenses in a seasonal business or an emerging business. And again, I can't emphasize enough the term temporary. Banks can't provide financing for 3 years until your business makes a profit. We're talking about maybe 3 to 6 months to cover working capital. And with the second two forms of financing for operating capital and working capital, often that's looked for in lines of credit, whereas fixed asset financing is more longer term. The loan process could be broken up into 4 key components. There's the pre-application process. This starts with your business plan and knowing how much money you need, what it will be used for, and what resources you have to pay the loan back. The pre-application process also includes initial research about the lenders and what's involved in their application, which gets us to the next step, which is the application process. Each lender has their own particular application that they like filled out. I do like to say it's not nearly as complicated as people make it sound. If you do a good pre-application work, it's a fairly straightforward experience, and your friends at the Small Business Development Center can help you out with that. The next process is the underwriting. This is where the lender makes a decision whether or not to approve your loan. And this is pretty much out of your hands at that point. And this is where the lender or the loan committee, in some cases, will review your application and see if this is a good fit for them. It's also important to understand just because someone doesn't finance you doesn't mean they don't like you, they don't believe in you. It just might not be the right fit at this time. So don't be scared of a no answer. Go into this hopeful. If it doesn't work with one lender, we'll work for other sources of financing. We'll look for other sources of financing. And then finally, there's the closing process. This is after you've been approved for your loan. Sometimes the lender might ask for some more supporting documentation, appraisals, environmental assessments, things like that. Sometimes there's life insurance requirements or covenants on your loan. This is certain benchmarks your business needs to hit before you can get the financing. So in those cases, you just want to make sure you dot your I's, you cross your T's, you get those things taken care of, and then there's the release of your funds. Let's talk a little bit about finding the right lender. First thing is to start with who you already know. If you have a pre-existing relationship with your business with a lender or personally with a lender, give that lender a chance to review your application or see if they're interested in going through the application process with you. So reach out to them. Other things to think about is the stage of your business. There are certain lenders that will outright say that they don't do startups. It's becoming a little bit more common, unfortunately. So obviously you don't want to waste your time with those lenders. Your industry. You might want to talk to some industry partners and see who they use for financing. Sometimes it's helpful to go to a lender that already knows a little bit about your particular business model. The size of your project may come into play. Some banks will have limits on lending, so make sure this is the right fit for them, especially with larger equipment and property purchases. And then there's your credit history. There's certain lenders that are going to be looking for those really high credit scores, 760 or above. So if you know you're below that already, you might want to look at some, what we call, in some cases, second chance lenders that are willing to take a little bit more risk. So what do lenders want? And this is really the key consideration. It's simple. Lenders want to get paid back their financing. They want to know that there is not going to be a default. A loan or debt financing is what's called an obligation. When you get approved for your loan, you're going to sign what's called a promissory note. That means you promise to pay the financing back. So lenders are going to be really careful in reviewing your application, and they're going to look at what we call the 5 C's. They're going to look at your character, which is your credit history. They're going to look at the capital, which is how much skin you have in the game. They don't want 100% finance your business. If you're not putting something into it, it's much easier for you to walk away, and you really need to understand that. They're going to look at your capacity. This would be your earnings history. What can you do? What can you, if the business doesn't work out, can you go out and get another job and still make some loan payments? They're going to look at the collateral. If the business doesn't work out, can you sell off some equipment and recoup some of that money? Or maybe you have some personal assets that you don't want to sell unless the business doesn't work out, but you're prepared to use that as collateral. That becomes helpful as well. And then finally, they're going to look at the conditions, which is the market volatility. This could be very regional, what's going on in your community. It could be the national economy. But again, lenders don't want to take too many chances, so they're going to do their due diligence in reviewing your application. Another thing lenders want is they want a clear presentation of your business model. It's important to understand that debt financing doesn't come at that high of a cost. Right now we're looking at, maybe 7% to 12% interest. So on a $100,000 loan, the lender is going to make $700 a year, maybe $1,200 a year. They can't spend too much of their time reviewing your loan application. That costs them their money and their personnel time. So make sure you clearly present your business model. You define your first form of repayment, and that means that your income, the cash coming in from your customers, minus the cash going out to your vendors for expenses, there's enough left over to make the loan payments. It's also important to separate out capitalization costs. These are the one-time uses of the financing versus your operating budget, and that's the ongoing expenses that you have to pay. Lenders are also going to be looking at return on investment that makes sense to both you and the bank. So it's important to understand that most lenders have a finance background. So again, let's use that $100,000 financing as an example. If after paying back the loan payments, there's only $5,000 left over, that's a 5% return on investment. A lender's going to say, geez, you could put that $100,000 in a mutual fund and make 5% a year. Why would you do this business where you're going to have to put your blood, sweat, and tears into it, and you're going to have to work all these hours to make $5,000? It just doesn't make sense to me why I would finance you to do that. So make sure your business model shows the likelihood of making some money for you as well. And then finally, there's that second form of repayment I talked about. You want to put in your application that you have the capability to pay back this financing no matter what. I always like to say you never get a second chance to make a first impression. So from the get-go, before you go to that lender, be professional, be organized, make sure you know what questions you're going to ask them on the first visit. When you turn in your loan application, make sure you have an organized and professional business plan that you're turning in along with your loan application. Uh, Other things to keep in mind is your narrative and your financial picture must align. So your business plan doesn't have to be the great American novel. It can be very short and it can be very concise, but it does need to make sense. As a business counselor, it's really common for me to see a narrative that talks about how much advertising someone's going to do. They tell me they're going to be on television, they're going to do the radio ads, they're going to be in the newspaper. Now I look at their advertising budget and it shows $50 a month. That shows me that you haven't put much thought into this. You can't be on television, radio, and in the newspapers for $50 per month. So make sure you do your research and make sure things line up. The other thing is make sure you show that you have an understanding of your business model and your ability to manage that business. Lenders are going to do a little bit of research about your industry, maybe 15 minutes, maybe a half hour, but don't let them ask a question from that 15 minutes of research that you can't answer in your hours of research being prepared to run this business. Another thing is, especially for startup clients, if you've never managed people before, make sure that you demonstrate that you're now ready to manage people, because that's one of the things lenders are going to be looking for. In review, just want to remind you that you need to know about the risk. You want to know how much money you're going to borrow, what you need it for. You need to understand the loan process. You need to find the right lender, get to know these people before you go and approach a lender. Be prepared to support your application with a very good, well-organized business plan and make that good first impression. Be professional. Thanks for joining us today. We're going to follow up with some more details on how to get your application in. We hope you join us.